Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get more on those UMich numbers. Hitting an 8-month low. Joanne Hsu is the University of Michigan Surveys of Consumer Director, and she joins us now. Hey, Joanne, what led this lower?
Still are just vociferously frustrated with the pain of high prices. This stands, of course, in contrast with the fact that we know inflation has slowed and consumer expectations for inflation have also slowed. Both of those things are trending in a favorable direction for consumers. But at the same time, 49% of consumers tell us that high prices are eroding their personal finances. That's pretty much the same as what we were seeing 2 years ago when inflation was hitting that peak.
They seem to conflict with each other. We're less confident, but we're more confident that inflation is headed in the right direction.
I think they're not really in conflict because they do believe that inflation is moving in the right direction, but prices remain high. And so they are telling us how painful it is to continue having their budgets eroded or eaten away by these continued high prices. So I think consumers are in a way separating their feelings and their frustration with high prices with an acknowledgement that inflation is moving in the right direction.
What about CPI from last week? Last week? This week? It all blends. Last week. Do we factor that in? How do you think that's going to affect the reading when you do the second read?
It's unlikely to affect the future reading because consumers aren't really paying attention to the CPI print. The CPI print comes with a lag from real-time data, and consumers are really responding to what they're actually seeing in the marketplace around them. So I don't expect a jolt from the CPI print, the most recent CPI print. But if consumers continue to perceive inflation as slowing down, we could continue to see that trending down.
I should just point out that CPI was yesterday.
Yes, yesterday.
So clearly, my
like
timeline is really tight right now.
All right. We move to the intersection of economic data and politics. Based on your reading, maybe in the past, what does this mean for the political setup? Can you delve into that any?
Absolutely. So consumers, we ask consumers a lot of questions about where they think the economy is going over the next year and over the next 5 years. And we have a lot of consumers who are responding with, I answered all these questions assuming such and such candidate is going to be winning the presidency, but if the other candidate wins, all of my answers will change. And we're seeing that for both presidential candidates and with views on both positively and negatively based on either of those candidates. So consumers are really acknowledging how much uncertainty surrounds their expectations right now. So I think we can really expect a bumpy ride ahead.
Joanne, we really appreciate it. We always love getting this instant analysis. Joanne Hsu, University of Michigan Surveys of Consumer Director, joining us there. UMich sentiment hitting an 8-month low.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Do want to go to the banks and take a look at JP Morgan, Citi, and Wells Fargo. Wells Fargo also the worst performing stock right now within the S&P. Alison Williams is Bloomberg Intelligence Senior Banks Analyst, and she joins us now. This is when I get to spend a lot of time with Alison, like this week, 2 weeks of the year. It's a good time for me. Alison, let's just start with Wells Fargo for a second. What happened?
So their net interest income is light, and they're guiding to the higher end of a 7 to 9% drop in net interest income. So still a lot of uncertainty, but the loans are what looks light there. So they're still talking about deposits and the pressure there, but the deposits actually, the costs are rising at a slower pace. So we think that's positive for the industry. But it's the net interest income, and then the other thing is the costs. So their operating expenses are going to be, or their overall expenses are going to be a lot higher. They have this line called operating losses, which includes remediation and some of the regulatory related costs. So that is also disappointing that those costs still continue to weigh. The positive thing we're seeing across all the banks, better fees. This is something we were looking for. The equity markets are strong. That's no secret. Equities trading really good. Equity fees picking up. FIC trading also doing well. And so that's all great. We are going to see, I think, higher expenses across the board because of that. Citigroup guided to higher end of expenses, but that's okay with investors, right? As long as you're getting higher revenue. It's those sort of lingering regulatory costs, I think, that we're disappointing at Wells.
These banks are all very different businesses, aren't they? Wells Fargo, to what extent are they into commercial real estate, and what does that mean for this bank?
So they're all in the same businesses, but to a different degree. And to your point, Wells Fargo is much smaller in these capital markets businesses where we're seeing a lot of the strength versus JP Morgan and Citi investing, but still smaller. And commercial real estate, they are the biggest lender in office. JP Morgan's actually now the biggest commercial real estate lender overall after FRC. But, the office, I think was not a big factor for Wells this quarter. They did increase their provision a little bit. We are seeing losses. JP Morgan sort of alluded to some losses. I think where we're seeing the issues, or Wells has said the issues are really in the institutional space. So they do have an 11% or so reserve there. I believe I didn't check this quarter, but the overall reserve is 8%. And so that was about the same this quarter. But that's something that's going to be a long story. We're going to continue to see that play out. But it's really, I think, the revenue side that's weighing on Wells. They are more levered towards net interest income, and unfortunately seeing some of the pressure there.
So asking for a friend who may or may not be interviewing the Wells Fargo CFO later at 3 p.m., what would be some good questions to ask? Like after getting through these numbers and seeing what the market's punishing. No, it's not. It is efficient because or else I'm just going to bug her later. What would be some questions you'd ask?
I mean, in terms of the loan demand, they've said they're cautious. Is there a reason why they would have more caution than others, or is it just a mix issue? But really, commercial and industrial, we saw a big pickup in some of the industry data. Why aren't we seeing that at Wells? And what are they seeing, right? And so we've gotten some news over the past couple of days with regards to potential changes in the interest rate outlook. How does that impact their views going forward?
Yeah, we're supposed to get a rate cut. Everybody thinks September. So how does that affect everybody?
Right, and the hope for banks would be that it would spur some loan growth.
But it happened over 24 hours, right? So it's like they haven't had enough time to really...
Correct. None of their views, everything that they've prepared and they're talking about today, right, that would be, baked in as of the quarter end. And they did say there's a lot of uncertainty, right? So we didn't see much movement. We saw one rate hike, I think, got taken off the table in the last 3 months. Entering the year, there's been a much bigger change, right? So we saw 3 rate hikes get taken off the table in 1Q. So people are feeling a little bit better today about prospects for the Fed, but my guess as well is going to continue to be conservative, and I think investors are going to want to try to feel out on the call. Is it conservatism, or are there more reasons to be worried? And I would tell your friend to ask the CFO about that.
Super duper, thank you.
I understand why Wells Fargo shares are lower. I don't understand why JP Morgan and Citigroup shares are lower, because those results were better than expected.
They were, but JP Morgan, I think it's a matter of the expectations, right? So it's always about what are the expectations versus the delivery.
Okay, what was the big takeaway from the biggest U.S. bank?
I thought solid quarter. So 20%. Return on tangible equity. That's pretty good. That's pretty amazing. And they keep warning investors that we're over earning. 17% is their through the cycle target. But
what's the secret sauce for JP Morgan and Jamie Dimon?
I think what they've done over the very long term is invest, and they just are enjoying a virtuous cycle of those leading market positions, right? So they've invested in their trading business. Mm-hmm. They've invested in deposits. They've made some good purchases. The one other key difference, Wells Fargo versus JP Morgan and Bank of America, is, they had this asset cap during the pandemic, and that really limited for them the opportunity to pick up a lot of customers. And so while there's a lot of talk tracking those balances, right? So we're moving down the balances, all the fiscal stimulus, et cetera. But if JP Morgan and Bank of America are holding on to those customers, that's a structural benefit that Wells missed out on a little bit, again, because of the regulatory issues.
So Citi is going through that 5-year restructuring stuff. Where are they in that? What did you learn?
I mean, they're getting closer, right? But it's going to take time, I think, to get through the numbers. But they did a lot of heavy lifting last year. Jane, I think, is really, making some tough decisions and made significant cuts. And I think that is really helping, but it's going to take a little while to flow through.
What's Jane Fraser's report card? What do you give her this semester?
So I don't know. Is that am I allowed to give grades?
I don't know if she's allowed.
I will say, like I said, she's getting it done. So I think that she's doing a great job.
Alison, thank you so much. See, this avoids me bugging her later. So now she can go write her reports, look through slides. I can tell my friend, we're good. Alison Williams, the amazing, wonderful senior bank analyst for Bloomberg Intelligence. Great stuff going on there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele. Paul Sweeney is off today. John Tucker is joining me for the 2 hours
talking,
as co-host.
I got to change seats.
As co-host, as well as doing our business flashes for us. This is Bloomberg Intelligence Radio. We cover all the top news in business and finance and economics through our lens of Bloomberg Intelligence Analyst. They cover 2,000 companies in 130 industries worldwide. We also go outside, of course, to get your take of how the people on the street are going to be viewing this and how they're investing their money. Phil
Paul's
Orlando.
seat is so hard. What is...
Okay,
Good
so John
Lord.
Tucker just literally ran over and sat and sitting next to me now. Now he's readjusting at the moment.
I needed to be closer.
He did need to be closer. Phil Orlando is Chief Equity Market Strategist and Head of Client Portfolio Management at Federates Hermes, and he is standing by. All right, Phil, I'm looking at the Russell. It's up 1.7%. The glory days of small caps, are they here, and will it be sustainable?
Small caps, yes. And that is an important distinction that we at Federates Hermes reiterated with an exclamation mark at the beginning of this week. We had gone to a 5% equity overweight at the bottom of the market last October, and the S&P 500 over that last 8 or 9 months up 35%. The Mag 7 over that same period of time was up 130% or some ridiculous number. But the small caps and the value stocks and the international stocks have really lagged. We think we're starting to see a reversion of the mean that's starting to happen. With small caps, we think are going to be one of the beneficiaries of that, along with value names and along with EM names. So our best guess is that this nascent move that we've seen with the small caps has legs, and we think this trend is going to continue.
Continue for how long, and what happens to the mega cap stocks at this point?
Well, our best guess is that the valuation of the Mag 7 names is ahead of themselves. Our full year target for next year, the S&P 500 2025 is 6,000. We broke 5,600 a couple of days ago. The market, in our view, the broad market, is well ahead of itself, largely driven by the significant outperformance of the Mag 7 names. So what we expect to see happening now through the balance of this year, maybe into next year, we'll see, is some profit taking with a lot of these Mag 7 names, because we think the valuations are extended, and a rotation in broadening out of this rally into the small cap names and the domestic large cap value names and the small cap names.
And
so
you would characterize this as healthy for the overall market, would you not?
We think it's incredibly healthy, because the market, the performance over the last 18 months between the Mag 7 and the forgotten 493 was about north of 100 percentage points. I mean, that's not sustainable. The valuation on this very select group of growth and technology names in our view, had just simply gotten ahead of itself. And so what is happening now, I'll use your words, it is very healthy. We think some of this froth does come off the top, and a rotation into these areas that frankly have been left for dead over the last 18 months is a very rational move by the market.
Here's my question. It's why is this time different? I feel like small caps have made a bid for it over the last few years, and it's never been sustainable. We may get those Fed cuts, but where are we going to get the actual earnings support?
Well, the earnings support is coming. That you look at, for example, the current quarter, which just started today, the second quarter earnings, it's going to be a pretty good quarter, right? Revenues are going to be up about 4.5% year on year. Earnings will be up about 9% year over year. It's going to be another terrific quarter. And as you look at the trajectory of the improvement in earnings, most of this over the last year, including the current quarter, has come from the very strong underlying fundamental prospects of these very select group of growth and technology names. But as we look at this trajectory over the balance of the year, the second quarter, even though it's going to be a good quarter, is going to be significantly slower than the first. The third quarter is going to be significantly slower than the second. Fourth quarter slower than the third. The areas that we like are showing an improvement in revenues and earnings from the end of last year, beginning of this year, into the end of this year. So there's going to be sort of two ships passing in the night, if you will. The underlying fundamentals, as measured by things like revenues and earnings, will get better for small caps and value and EMs, and will deteriorate for these Mag 7 names. The stock market ultimately, as a forward-looking discounting mechanism, will attempt to begin to price in these sorts of developments 6 to 9 months before they happen. Now, if we think we're seeing this over the course of the balance of this year, let's say the fourth quarter is when this truly manifests itself, then now is exactly the time when the market should begin to recognize this trend as we're getting into the second quarter earnings season and digesting the earnings and the guidance, and then begin to recognize that valuations need to move in different directions for these different asset classes.
Some stocks are more forward-looking than others. With a lower interest rate regime, if that's where we're headed, what's your outlook for particular sectors?
Well, you're exactly right. We do expect interest rates to move lower. We're not quite as sanguine or optimistic as the consensus, which I guess believes that we're going to see the first rate cut this cycle in September. We're still in the camp that we do believe that there will be one or two rate cuts this year, but we think that both of them, one of them or both of them, is going to come after the election. So that would suggest the November 7th or the December 18th FOMC meetings. We think that trend continues over the course of next year, with another 100 basis points of cuts in the funds rate coming, probably on an every other meeting basis. So if you give me the luxury of looking out 18 months, you've probably got the funds rate down 150 basis points. That should be a very constructive tailwind for small cap companies that historically do well when interest rates come down.
Mm-hmm. What do you do with bonds then in that environment?
So our view on bonds is that we should be lengthening out or looking for an opportunity to lengthen out duration. Okay. That if the funds rate is 150 basis points lower 18 months from now, then treasury yields are probably going to be lower as well, which means that if I had the opportunity to start to lengthen out duration at 5% or 4 3/4 or even 4.5%, I think that's a reasonable bet. So if we're going to, again, look out 18 months, could we see benchmark 10-year treasury yields, down below 4%, 3.5%, something like that? If the answer is yes, and that's the direction we think we're going, then extending that duration here, in the 4 to 4.5% neighborhood, in our view, makes sense.
Do you expect a September swoon? It is coming up on that time of year.
We do, which is why we took 2 points out of our 5% equity overweight at the beginning of this week. The stock market, in our view, is ahead of itself. Stocks are overbought. We could absolutely anticipate, at a minimum, a 5 to 10% correction, which we think would be very healthy. looking out, say, between now and the election. So stocks have done really well. We would expect to see sort of a rotation here, a reversion to the mean, if you will, in which disproportionately more money comes out from a profit-taking standpoint on the stocks that have just gone vertical, and see this rotation into a lot of the sectors like value, like the small caps, like the EM names that haven't performed anywhere near as well as the Mag 7 names have.
Wow. Okay, I better get that money out of my money market fund now. If we're going below 4 for the 10-year. Yeah.
Which is also Ira Jersey's call before the end of the year.
Yeah, I'm going to be one of those people. All right. Hey, Phil, thanks a lot. We really appreciate it. Have a great weekend. Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management over at Federates Hermes.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to the story that is really upsetting John Tucker, and it's this AT&T story. AT&T stock obviously falling, disclosing some hack of calls and texts that affected its customers. John Butler is Bloomberg Intelligence Senior Telecom Analyst, and he joins us now. John Tucker's now getting on his phone.
Why wouldn't it upset me?
I don't know what he's doing there.
Outrageous.
Okay, John, should John Tucker be nervous right now? What's happening?
No, John Tucker should not be nervous right now. What was stolen
end
was...
of interview. Let's move on.
Keep going.
I recently had my ID stolen. I think it's become quite common. And what happened at AT&T is they had their call logs breached. So, when you make a call, AT&T logs the originating number and the called number, and they generate billions of those data points. And so they need to store that data off-site with a third-party provider. Bloomberg reported that it was Snowflake that was actually breached. It was housing the AT&T data. This all occurred back in 2022. So, John, if you were not a subscriber then, I think you're really safe. But the risk is, or the fear is, that hackers could use that data to potentially blackmail politicians or other vulnerable parties who may not want that call information released.
Or like somebody like, hey, why was John texting Alix at 2 a.m.? I mean, that
Right.
didn't happen. I'm just saying.
I mean, I don't know if that rises to the moment, but it's fair.
I'd pay good money to conceal that data. Why? I don't understand.
Hey, the hackers are counting on that, John.
So it came out, you're saying, in a regulatory filing that we saw this morning. Well, why now? Why did it come out now? Why didn't they tell us about this earlier?
So that is a good question, and one that I don't have an answer for, but I believe it probably has to do with, understanding fully what the breach encompassed. I mean, it's one thing to discover a breach, and it's another thing to understand the details around it and work with the FBI to really understand the scope of the breach, when they actually were able to truly lock it down. So I can't speak to the specific timing here, but that's my guess, it had to do a lot with getting all their ducks in a row, so to speak.
Okay, but there's a lawyer out there. There are lawyers out there listening to this program saying, wow, this is going to make a great class action lawsuit where I can get lots of fees. How vulnerable is AT&T to some sort of legal action and the money that would flow from that?
Or just like brand damage?
Yeah, well, I'm more worried about the latter. I think they're vulnerable on both fronts. So, John, as you suggested, I think the lawyers are sharpening their teeth here. I mean, they are vulnerable to consumer lawsuits for breach of data. I think all companies are when something like this happens. What I worry about is, this is the second breach this year. So they announced a separate breach back in March of equal scope. And here we are again now in July, and it's a rerun of everything. And so my concern is that the AT&T brand gets tarnished, at least in the near term. One thing I have noticed with the telecoms and other companies is people have a short memory on this. Fast forward a year from now, I don't think people are going to remember this. But in the near term, people who were thinking of switching to AT&T may in fact think twice.
Well, also, switching phone providers stinks. It's like really hard.
It's high friction. And so my concern is not higher churn or losing subscribers on the news. I think it's more getting those gross ads going, as they call it, people coming into the brand. Mm-hmm. And I think the risk is, at least for the next 3 months or so, people may think twice about it while the headlines are fresh.
John, we have earnings coming out at the end of July, so they're going to be before the market on July 24th. What can we expect? What should we be paying attention to? I mean, they have a nice gross dividend yield of almost 6%. What are you looking for?
Yeah, so two things for AT&T. Number one, everyone focuses on their free cash flow because they're a bit over-levered in the wake of that Time Warner acquisition and the unwinding of all that. And so they're trying to manage down to a debt leverage ratio of 2.5 times by, I believe it's the end of next year. And they're getting there through free cash flow growth. And so for the investment community, that's a real focus. The other lightning rod for all of the telecoms is postpaid net subscriber additions. And so that's the contract business, not the prepaid business. People like you and me that pay a bill on a monthly basis, but we're sort of on a contract. We don't have to prepay in front of the month. And those are higher price subscribers and the ability to drive net growth there through what are called net adds. So that's gross additions, people you bring in minus those that you lose. If that's a net positive and it's getting bigger every quarter, that's good. If it's moving lower, which it is for all the carriers right now, that can be seen as a net negative. So there'll be a lot of focus on that number going into the quarter for all the carriers, AT&T included.
This one's kind of out of left field. I remember when the promise of the switch to 5G. I didn't notice anything.
You didn't?
I did.
From 3G to 5G?
I went from like 1G to 5G. I didn't notice anything.
Yeah, really?
Yeah, it's funny. 4G was much, much more impactful for the consumer because it put streaming video into our palm tops. And 5G will increase download speeds for sure, but it's much more impactful on the business-to-business side because it's a software-defined upgrade. Without going into detail, that really gives a lot more flexibility for the carriers to create very interesting new services on the business side. I have to say, I think 5G has disappointed in that regard because even though the carriers are ready to deploy these services, I don't think the appetite on the business side has quite been there as originally expected.
Outlook for Telecom, mid-year outlook in what? How much time we got? A minute left?
I think it's steady as she goes, John. You know, as I said, there's slowing subscriber growth now post-pandemic. All of the carriers, like every company on the planet, has been sort of edging up their prices, and so that actually is providing a bit of a floor to revenue growth. So as much as you're losing subscribers, price increases have a much broader impact across the whole subscriber base and the revenue line. So I think revenue growth will be a tad lower from last year, but still I would, again, characterize it as steady as she goes. And as you mentioned before, we have very good yields at AT&T and Verizon, and so that will be a focus going into the calls as well. Yeah,
particularly if the Fed cuts and you get lower rates in the 10-year. Very interesting. All right, hey, John, we really appreciate it. I think you made John Tucker feel better. That was John Butler, Bloomberg Intelligence Senior Telecom Analyst.
Worried.
You're still worried. Fair enough. You know what I have to do every day now? I have to turn my phone on and off because or else it doesn't work properly. What does that mean?
It means you need a new phone.
But it's the iPhone 14. I don't understand.
I don't know what I have.
Oh, he's a flip phone. No, I'm kidding. He doesn't. It's not that bad.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So Paul Sweeney is out today. I'm Alix Steele, and Jen Tucker is subbing. He's also himself, and he's subbing for Paul Sweeney. This is Bloomberg Intelligence. We bring you all the top news in business, economics, and politics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies, 130 industries around the world. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Also, check us out on YouTube. So let's get to that news conference last night with President Biden. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, is joining us on that. So here's the media narrative, right? The Democrats seem to be now calling for Biden to step aside. The headlines continue to not look good. That's the media side. Is any of that true on the polling side?
Well, we watch the prediction markets very closely, which, we can find it on the terminal at WSL Election. And going into the press conference, Kamala Harris had quite a sizable lead in terms of who was going to be the nominee. 50-37. Now, at the end of the press conference, President Biden had actually changed the narrative and was up 44-41. And I just checked about 20 seconds ago, President Biden is up 46-41. So in the eyes of the predictive markets, President Biden had a very good night. Now, you mentioned the Washington angle, though. That has not stopped the calls from Democrats for President Biden to step aside. In fact, we saw one just a few minutes ago. Now, I think what will happen here is with the Republican convention starting next week, some of the news cycle is going to break away from whether President Biden should run or not and move over to Milwaukee and what President Trump will do. But for the Democrats, last night was a good night for Biden, but overall, it doesn't change the narrative. They're sort of stuck in the status quo of should he run or should he not.
Okay, in his response to some of the great questions that he received from some of the Bloomberg reporters at that, did he sound a little more malleable, is the word maybe, to change?
Well, I would say that he was pretty stuck in. I mean, when Josh Wingrove gave that great question on should he stay or should he run, he sort of just said, look, the polling suggests that I should stay. Now, that's not some of the polling that we've seen across the news narrative. So the question here is for President Biden it's an ultimate gamble. If he honestly believes that he is the best person to defeat Donald Trump, he's going to stay. But, we saw House Minority Leader Hakeem Jeffries just say that he spent some time with the president last night talking about what should happen here. So I think there's going to be a lot of serious conversations in the Democratic Party that will take place over the next week. And eventually, President Biden is going to have to make a decision before, they get him onto the ballot, and so forth. Is he going to stay? Is he going to go? But as of right now, I think if you were to give President Biden truth serum, he's going to say, I'm going to stay.
But do we trust any of the polls? I mean, when have polls been reliable last?
I tell clients all the time, I don't trust polls until 2 weeks before then. And even then, I still am suspect. So, what we should think about here is process. Now, the Democrats have time, because next week is the Republican convention. Obviously, the news cycle is going to turn to that. But because of the way the Ohio state law is, President Biden has to be nominated by August 7th to be on the Ohio ballot. This is before their convention in late August. Now, the Democrats have been talking about holding a virtual roll call. They're dusting off that COVID playbook to have a virtual nomination per se for President Biden for the state of Ohio around July 21st. That date is not set in stone. So up until that point, they can have these conversations. Once they nominate President Biden to the Ohio ballot, however, it's going to be extremely more difficult for him to say, I'm not going to run, because then you would get into a situation where President Biden's on the ballot in Ohio, but he may not actually be running for president.
Who are the key people in all this who talk to the president? When does it happen? This weekend?
I think this weekend is actually going to be a good, reset moment for President Biden. He may go, I don't know, I can't recall his schedule. He may go back to Delaware or not, but he obviously has his inner circle of allies. But then you also have heard through the news cycle that, President Obama is beginning to opine on this. It was reported that he spoke with George Clooney before George Clooney put that op-ed calling for President Biden to step aside. So I think there's just a lot of people that are going to be talking to the president. I think the problem here is that you get a difference of opinion depending on who you are in the Democratic Party. Most of the people that are calling for President Biden to step aside represent Democrats in either bipartisan purple states or red states. You see a lot of Midwestern Democrats calling for President Biden to step aside. It's those Democrats that are in more safer seats, I think, in New York City, if you will, that are saying, no, President Biden should stick it out. So I'm not exactly sure who's going to have the president's ear this weekend, but I know a lot of people are going to be trying to get that voice time.
For investors, what should they care about? Because you cannot hedge or price in political strife. I mean, since Brexit, and even that was like, 6 or 8 weeks that you could price that in. What do investors do with all of this?
Yeah, so you have here the micro view and the macro view. So if you're thinking micro, like what's the individual impact on a company? Whether you get President Biden or let's say Vice President Kamala Harris, I'd say about 95% of the policies that we cover at BI would be the same outcome whether you have Vice President Harris or President Biden. So on the company specific impact, I don't think there's much uncertainty there. Now, the question then comes from what's the uncertainty on the macro level? And obviously, this is the more important at the market perspective. Now, if President Biden were to say that, I think the worst case scenario for the markets would be if President Biden says, I'm going to stick in, I'm going to stay, and then after the Ohio date or after the convention, he announces he's going to resign, then you have an election where essentially people will have to go to the ballot to vote for Joe Biden, but knowing that he's not going to be the president, and then it would be in the hands of the DNC to figure that out. That's a lot of uncertainty there. An open convention in Chicago may not be a good thing for markets, but ultimately, when you look at the differences between President Trump and whoever the Democratic convention or the Democratic nominee will be, you get a pretty stark contrast there, and you'll be able to at least pick and play scenario analysis with either of those.
Does Vice President Harris have a role in talking to the president at this point, or it just be self-serving?
Ooh, that would be so dicey. Like, hey, can you step aside so I can run? Thanks.
God, I wish we knew the answer to that one. But I will say that, the Vice President Harris has been on the road lately. She was in Texas just recently, saying the same message. And, we've heard behind the scenes that, President Biden is the nominee. We need to get behind him. I would just say that, this is one of those situations where I think she is more likely just to say, I'm supportive of the president, but let's let the process play out. But again, it's just really hard to tell.
Before I let you go, RNC's next week. We haven't even really talked about that. What's the number one thing you're looking at?
The number one thing I'm looking for is the vice presidential candidate. Is it going to be, Senator Vance from Ohio, Governor Burgum from North Dakota? Does Nikki Haley even have a chance? There's a couple of people whispering around Washington that she could be a surprise pick. I'm not sure about that. But what I'll say is the vice presidential pick is important because it may show how President Trump is going to try and appeal to moderate voters going into the election. He pulled strong abortion reproductive right language from the RNC platform, and maybe his vice presidential pick could be an additional play off of that.
Yeah, but that all makes sense. But, in the world of Donald Trump,
reality.
Do you want somebody who's going to maybe upstage you and look better than you?
Ooh.
John,
no, don't say that.
We got to bring it down to D.C. because that is the conversation every single one of us has been having.
Yeah.
If he picks Senator Vance in 2 years, you have your your replacement there right for you.
Hey, Nathan, we appreciate it. Thanks a lot. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to some of the news here, and that is NATO over the last few days. President Biden, of course, had that news conference yesterday. We had Jens Stoltenberg, the outgoing NATO head, speaking to Bloomberg earlier, talking about how he expects the U.S. will remain a strong NATO ally. Of course, who wins the presidential election will have a lot to do with that. So we want to check in with Dr. Ariel Cohen, senior fellow at the Atlantic Council. He joins us now. Dr. Cohen, what is my NATO takeaway right now over the last few days?
First of all, this was a celebratory meeting of the 75th anniversary. And I think NATO is getting a little bit long in the tooth. It is not facing the real challenges. I would like to see much more vigorous leadership there that you and I may agree or disagree whether President Biden provided it. But more importantly, we see a lot of redundancies in NATO procurement. We see shortages of equipment and materiel. We see shortages of soldiers, of grunts on the ground in Europe. But on the other hand, we also saw for the first time NATO expressing grave concerns about China supporting Russia So NATO is increasingly a global alliance led by the United States. And President Biden, if elected, will be ill-advised to discard NATO. We all are aware of his pessimism about NATO, his rhetoric about NATO.
You mean Donald Trump, right?
I'm sorry, Donald Trump, of course.
Okay.
So Trump will be ill-advised to discard NATO in the era of confrontation with Russia and serious friction with China. We need our allies, coalitions, and industrial potential win wars. We saw it in the 20th century, World War I, World War II. The allies had a bigger and stronger coalition and industrial base in World War I and World War II.
Has NATO been able to Trump-proof itself?
NATO is not sufficiently Trump-proofing. If by Trump-proofing we mean the U.S. that disconnects from Europe or focuses on China, as some experts in Washington suggested, just forget Europe, let Putin have Ukraine, let's all focus on the Pacific. This is not the way to go. But Europe has multiple models of fighter aircraft that don't have strategic bombers. They have multiple models of main battle tanks and insufficient production of 155 millimeter shells, not enough missiles, although they're capable of producing the missiles and the drones we need in today's world. The production is shifting. It's no longer these single, very over-engineered, very expensive platforms. Think F-35s, F-22s, think the Sentinel ICBMs. We need mass production of cheap drones, and this is something China may excel in. The warfare is shifting. We need a balance between the sophisticated and expensive systems and mass-produced drones.
I mean, that's a fascinating point, the cheaper drones, but even in that area, you have some of the big technology companies in the U.S., because of political pressures, refusing to go down that route, and certainly the U.S. defense industry may not have the wherewithal in terms of spending to develop the drones that could potentially be a big threat to the structure that we now have in place.
Well, think about the current naval structure: 12 tabletops, aircraft carriers, flat tops. Each one costs billions and billions of dollars and many more billions to protect, and can be taken out by a swarm of drones, even to go into sci-fi area that ceases to be sci-fi. An AI-controlled swarm of drones taking out an aircraft carrier. Think about the consequences. 6,000 plus sailors and soldiers on that aircraft carrier, and massive escalation in the Pacific, for example. Think about these $2,000 drone taking out a $2 million tank in Europe. Ukrainians are planning to produce 1 million drones. The Russians are planning to produce 2 million drones. And now Russians are getting technology from unexpected sources like Iran and North Korea and China, by the way. This is the reason for NATO mentioning China so sternly and severely in the NATO document. So the shift of warfare and production is moving very fast. And I'm not convinced that the Pentagon has the procurement procedures that are broken. I'm in Washington, D.C. I'm doing it for a living. I talk to people who know the Pentagon procurement in and out, inside out. And they are complaining that the procurement system is broken. And because of the revolving doors with the military-industrial complex, the generals are not ordering
Yeah.
the cheap systems the military-industrial complex doesn't want because they're not making as much money on cheaper drones vis-a-vis F-35s.
Yeah, it's interesting. I just wanted to add that Peter Thiel, no matter what you think of the investor, he's kind of taken up the slack in terms of investing in small startups that specialize in these advanced drones. So there's a lot of attention being paid to that because it's just not coming from other avenues. And that seems to be, as Dr. Cohen just mentioned, one of the big threats we're facing, especially in the Pacific with the fleets, the carrier fleets. So take that for what it's worth.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.